Welcome to Celebrating Act 2. Celebrating Act 2 is the user manual for the second half of your life.
Welcome to another episode of Celebrating Act 2 with our great financial planner, Dave Samuels. Thank you, Dave, for joining us last time, this time, and hopefully the next time.
Thank you.
Dave, I love the fact that you have broken the concept of financial planning down into 5 pillars, 5 major elements. And we've covered 3 of them already. Today, we're going to talk about risk management and / insurance. I guess they relate to each other. I'm not sure how, but I first wanted to start with risk management. As an investor, I don't play the stock market, but I do invest. One of the lessons I've learned is that you have to manage your risk. It's one thing to have an investment, but you have to recognize that, particularly in the stock market, things are going to go up, things are going to go down. You need to mitigate that going down, right? It's not as so much as making a lot of money; it's not losing it. So risk management is a concept that I'm very familiar with, but a lot of people don't understand that idea that you have to protect what you've got as you grow. You want to grow. It's not necessarily the goal to double your money, as long as you can grow at a moderate rate and protect the downside. So how does a financial planner help us with risk management?
Okay, well, there's a couple different definitions of risk management. The basics, John, are going to start with, think of your auto insurance. Nobody, or at least hope not, drives without auto insurance. You total your car or you cause an accident, you want coverage. It's called liability. You don't want if someone sues you, you want coverage. And of course, you want to replace that car. So the concept of insurance is you're paying a small amount of money into a pool. If a catastrophic or significant event occurs, you'll be made whole again or close to it. That's your auto insurance, that's your homeowner's insurance. Life insurance is a little different concept because you're insuring your life. There's where we run some numbers and do some modeling, and we'll figure out an appropriate how much insurance should you have. And for a lot of people, maybe none. I talked to a gentleman yesterday. I think is about 62, 63, very healthy, has no family, no heirs, a nice portfolio. He says, why do I need life insurance? I said, maybe you don't. Speaking to young couples, husband and wife, couple of kids, in their 30s and their 40s. So I always ask the question, if one of you passes away tomorrow, how is that going to affect you financially? And they look at each other and say, oh my God, we can't go on. We got to get that risk covered. Well, that's a simplistic risk for life insurance. So the intention there is, of course, to replace lost income. Right. Occasionally, people will buy life insurance for estate planning purposes. If they have significantly large estates, they say, I know right now for a husband and wife today, this law may change, but today, a husband and wife can pass away, and between the two of them, they have a significant amount of money that will not be taxed. It's like over 11 million bucks. That's huge. So you're saying, who has estates over 11 million bucks? I guess some people do in California anyways. Those people sometimes will entertain life insurance. So it's to cover that risk of covering taxes, of being exposed to a large tax bill. John, you referred to risk management in the stock market. Well, the basic risk management tool that we use, planners all the time, is diversification. Look, we can pick a stock, we can pick something and put all our money into it. When that stock goes up, we're really happy. We think we're brilliant. Look at my stock. I have all my assets in that stock and it went up this high. Could be Bitcoin. We'll pick on Bitcoin. Wait till that stock tanks. Then you say, whoops, got a problem, and it might be too late to fix. Because it's real common for things to tank, as we saw in the crash of 2008, and maybe not come back, or come back very, very slowly. So to spread out into 3 basic asset classes, our stocks, bonds, and cash, that helps mitigate risk. As you point out, John, you're not going to shoot the lights out, But when the market crashes, you're not going to lose your shirt.
So, are there other elements of our estate, our financial world, that we can use risk management to soften the blow if something goes wrong? You mentioned stocks and bonds and
Oh, well,
insurance.
yeah. I mean, insurance is your primary risk management tool, John. And for example, we use it for our health. You know, you hit age 65, Medicare kicks in, of course, you pay for it. And that offsets hospitalization, doctor's visits, prescription drugs, things of that nature. So that's a significant, let me give you a significant risk. Imagine you're age 60, and I mentioned this, I think, in my last video, and you say, I want to retire. The first question we like to ask, how are you going to cover your health costs, your medical insurance? Someone says, oh, my husband or my wife is still working. I say, great. Make sure they keep working for another 5 years. You're probably covered. Because then they start shopping for premiums on health insurance that's expensive. So that kind of risk management is there. The medical insurance has changed quite a bit over the years, but as you know, it's a critical type of insurance. Another type of insurance is long-term care insurance. As I mentioned previously, most people don't have it, and for many it's quite expensive, or they're what we call uninsurable. Migrating the conversation to the stock market, there's really, I'm going to say, I don't know of any insurance tools. There's basically what's called derivatives in the stock market, that if the stock market goes up, the derivative will go down, and of course, vice versa. That's pretty esoterical. And after we finish explaining it to people, most of them, they're heading for the exits. So the basic risk management tool in the stock market has been for years and still is, and quite effective, is diversification. And once again, the purpose of diversification is something goes up, that other something might stay the same or go down. But once again, if the stock market goes down significantly, you have enough of a cushion in your portfolio where you're not going to be happy, but again, you're not going to be decimated.
Good point. You mentioned long-term health care insurance. How common is that? From what I know, it's pretty expensive stuff.
Yeah.
Yeah, and also,
Okay.
also since we have some friends who have serious illness, but one of them was a professional, and they bought it, I guess, when he was in his 30s, and he's probably one of the healthiest guys you'd ever want to know. In other words, he was the last one you'd figure would ever have a problem, and they're getting close to having 7-day-a-week full-time help because they have a policy without anything coming out of their pocket. But it seems to me that if you don't get it when you're very young, the costs get much more prohibitive as you get older and older in age.
So John, you brought up a good point. What you just said, I'm going to paraphrase and stretch, is that if you can look at long-term care when you're very young, in your 30s, that's incredible. That the person who did that, they get a big gold star from me, because you talk to most 30-year-olds, not only do they not know what long-term care is, they don't want to know. They're never going to get old. They're never going to sick. Why are they wasting their money now? Look at it, it's a big ripoff and all that. Sure seems that way until you use it. Because the policy that person got 30 years ago, I guarantee they cannot get now. The long-term care industry has changed to the point where there are fewer policies and they're much, much harder to get, and the benefits are much less. So long-term care covers two basic areas. It covers in-home, and it covers in skilled nursing, and then assisted living in a few other areas. That's called comprehensive long-term care. That's the preferred insurance we like to see. Very few people have it, and more often than not, by the time they come in here, they're too old or frankly too sick to get it. Just think about it. Someone ends up in skilled nursing. You've got Medicare and a Medicare supplement. That'll cover, maybe if you're lucky, the first 100 days, maybe. From there, you're on your own. I know a few people in long-term care right now is in skilled nursing, and the cost is about $12,000 to $13,000 a month. $12,000 to $13,000 a month. Most people don't need a financial planner or even a calculator to figure out that's going to hurt the bank.
Yeah.
So you got to figure out, what are your choices? You don't have insurance. You don't have enough assets to cover yourself. Then we have to stretch the conversation to considering a reverse mortgage, which we don't write. We have to talk about it. And we also, frankly, have to talk about Medicaid or Medi-Cal. Those are other areas, and that's a little too much of a conversation for this short video. But those are the conversations we have to have and explain to people. By not having long-term care or being prepared, that's what we're looking at to carry you on through these years.
Yeah, and as Art loves to point out, our generation is living longer, and while we are generally much healthier than our parents and our grandparents' generations, it doesn't last forever. Your health does deteriorate, and at some point, you do need help. And of course, society has changed significantly over the years. My grandmother, grandaunts, they all lived together. They all took care of each other. Their children took care of them. And that's not the case anymore. Grandparents don't live with their kids or grandkids anymore, and nobody's there to take care of you. You've got to have the insurance, I think. But, like all insurance, it's only affordable when you buy it, when you don't need it, when you're young.
It's a good point, John. It's like nobody insures the house that's burning down. No one will insure the car that just got totaled.
Yeah.
So the time to buy it, as you said, and you said it very well, is when you don't need it.
Yeah.
As they say, yeah.
Sure. That's the hardest thing about buying insurance. I remember when I bought my first life insurance policy at, I don't know, age 26 or something. It was very difficult to, to accept the idea that I'm going to need this someday, that I'm going to die,
I think you have to spend money every month. Perfectly good money going out the door for something you're never going to need. Yeah.
Right.
And that's why we always define insurance as protection against the unforeseen.
Right.
Yeah.
All of us like to see the good things. We're kind of opportunistic. No one wants to foresee the bad, but then again, that's why you consider purchasing insurance.
So I think it's fair to say that another one of the really great values in seeing somebody like yourself, particularly at an earlier age, and obviously we always have choices as we get older, and since you've seen enough of those situations, you can help somebody to at least navigate to the best possible solution, even though it may not be terrific at the age 60, 70, and 80. But the sooner somebody gets to see you and gets to get a good sense of what they can realize that maybe at the age of 30 or 35 or 40, they can make some decisions that will benefit them immensely at the end of their life. And if they get into the habit of taking care of a few dollars now that they don't want to spend but do spend, as opposed to the tens of thousands or totally unaffordable amount it might be just 10 years later.
Yeah, and that, John, you brought up a good point, because once again, on the insurance conversation, it's very common. We do a lot of consulting work, especially on life insurance. And the typical situation is someone comes in here who's in their late 50s on up, has a life insurance policy, asking, can we do better, or should I even keep this thing? Well, can I do better? The answer is usually, nice try. What you got it when you were very young and very healthy. And believe it or not, you've got a very good policy. Keep it. Then we do the assessment, do you even need it anymore? And once again, things change. For those that have done a great job of saving, have a large portfolio, maybe the need for life insurance is not there anymore. But more often than not, we'll have people come in and want to switch it or buy something else, and they have that health problem, and we'll say, I know you're not happy, you think this is expensive, you're best off. Just hold on what you got.
Yep. My first insurance broker gave me the best advice, and he said, don't ever sell this. He said, you will never get insurance as cheap as this again, because you're getting older.
Yeah.
And you know what? 20 years later, I bought a policy. I fell for an insurance salesman who said, oh no, we're going to take your policy and we're going to wrap it around with this and the old wraparound routine. And you know what? It was about 5 years later that I realized, holy cow, I shouldn't I shouldn't, this wraparound deal didn't work for me. I needed to keep my first insurance policy, not trade it in, not do wraparounds, whatever the lingo was.
And
I
that's
got
why,
more insurance, but it wasn't as good.
yeah. And that's why we keeping our certified financial planner hat on, we're always doing comparatives. Here's what you got. Here's what you're looking at. And I usually tell people up front going in, usually you're better off keeping what you have. We're going to do the full evaluation.
Right.
And there's a couple of agencies we will send their existing policy out to and get their opinion. And they're pretty good. I mean, it sounds like a bad joke, but they'll kill 90% of our cases. What that means is they're saying, Dave, advise them, keep what they have. They're not going to do any better.
Yeah, I have to be a model under the term decent investment. 50 some odd years ago, I got talked into an insurance policy that was whole life, not term. And guess what? It's fully paid up. It's worth more money than the face value of it. I get dividends every year, and it'll have a payout someday, which will take care of some expenses that my wife won't have to worry about. And it was probably the best single investment I ever made because, and I trusted the guy. I knew him for about 30 years. We've since moved apart. I haven't seen him, but it was the best advice I ever got was an inexpensive policy. Inexpensive, the premiums haven't changed, and it was a whole life policy. And I'm sure that you can help people think about all these things. And maybe now a term would be good for somebody if they just want to cover funeral expenses, that kind of thing. So, but having somebody who is not selling them the policy, advising them, I think is a very wise thing to do. I just happen to get lucky with this particular policy.
Yeah. And again, it's just, that requires a full evaluation and assessment. Because we always ask, what is your intent and purpose for buying this? There's a whole lineage of questions we go through to make that assessment, to make sure, and then we'll compare. Here's the whole life, here's term, here's universal life, and just let them know the pros and cons of each, and whichever way they go, that's becomes their choice.
Well, John, I think we've got another fascinating masterclass. What do we have, 4 pillars so far?
This is part 4, yeah.
Yeah, part 4.
You know, as we leave on our way to part 5 in another video, I just wanted to recall that, Dave, you and your company are fiduciaries. You don't, your priority is the best interest of your clients, as opposed to selling products and making commissions and things like that. And it seems to me that a certified financial planner like Corinthian Wealth Management is a really good advisor to have, whether I act on anything or not, whether I change anything or not. What a great resource to pass in front of and say, what do you think of this? What do you think of that? I love the idea that you guys will analyze, in this case, insurance or whatever, but all the other options we've talked about, the other pillars of financial planning. So I think you're a great resource, and I want to thank you. And we're looking forward, by the way, to our last pillar.
Which
is
investments.
What is it?
Investments.
It's investments.
Yeah.
I have to ask you, Dave, why would investments be the last pillar we talk about?
Well, because they're always in the news. People always seem to have them on the mind because they watch the TV. They see the market goes up, goes down, goes sideways, something's new. Everyone's in it, they're going to miss out. So in some ways, it's more approachable and easier to talk about. Insurance is the least fun. No one wants to talk about dying or getting sick or having the car totaled.
Yeah.
So it's just because it's an easier taxes. Nobody wants to pay them. So I mean, you have the pillar where it's exciting and dynamic for a lot of folks to jump into and talk about.
Oh, great. Well, I look forward to that next session, and when we introduce ourselves as your audience and our audience to investment. So thank you again for a fascinating look at wealth management.
See you soon, Dave.
Okay, see you soon. Thanks.
For more on Celebrating Act Two, visit our webpage, follow us on Facebook, subscribe to us on YouTube, and tell your friends. Celebrating Act Two is the user manual for the second half of your life.